Welcome back. This is Catherine Morgan-Nance. In part 2 of this video series, we will review two absorption costing examples. ARCO, Inc. produces and sells 25,000 units of a single product at a sales price of $30 per unit. Variable manufacturing costs total $10 per unit. Variable selling and administrative expenses are $3 per unit. Fixed manufacturing overhead for the year is $150,000, and fixed selling and administrative expenses for the year are $100,000. Can you calculate the amount of fixed manufacturing overhead per unit using absorption costing? We'll see the answer next when we review how the total unit product cost are computed under absorption costing. Unit product cost is $16 per unit under absorption costing. It includes all variable manufacturing expenses totaling $10 per unit. These include direct materials, direct labor, and variable manufacturing overhead. It also includes fixed manufacturing overheads of $6 per unit. We determine the amount of fixed manufacturing overhead per unit by dividing the total fixed manufacturing overhead of $150,000 by the 25,000 units produced during the period. So 150,000 divided by 25,000 units produced is $6 per unit. Let's continue with our example and review an income statement prepared using absorption costing. Shown is an absorption costing income statement using the cost data provided by ARCO. Absorption costing uses the traditional income statement we discussed earlier, and this is the format that must be used for external reporting. Costs are organized by whether they are product or period cost and are grouped together without regard to their cost behavior. Product costs, as you recall, are reflected in cost of goods sold once the product is sold. Therefore, cost of goods sold is equal to the product cost per unit times the number of units sold. In this case, cost of goods sold of $400,000 is calculated using the fully loaded product cost of $16 per unit times 25,000 units. We'll see later that the product cost per unit may vary depending upon production levels during the period due to the existence of fixed manufacturing overhead. For now, remember that sales less cost of goods sold equals gross margin of $350,000. We also commonly call this gross profit. Notice also that selling expenses of $75,000 are computed by multiplying the number of units sold by the variable selling cost per unit. So we have 25,000 units sold times $3. And all selling and administrative expenses are reported as period expenses. They are subtracted from gross margin to determine net operating income of $175,000. Now let's change the facts and see what happens to our income statement. Assume ARCO produces 25,000 units but sells only 20,000 units. Assuming there is no beginning inventory, 5,000 units will remain in ending inventory at the end of the period. We shall see that all the cost per unit calculations are the same as the example that we just looked at. In example 2, this example, ARCO sold only 20,000 of the 25,000 units produced, leaving 5,000 in ending inventory. At a sales price of $30 per unit, sales revenue for the 20,000 units sold is $600,000. And at a unit product cost of $16, cost of goods sold for the 20,000 units is $320,000. Subtracting cost of goods sold from sales, we find the gross margin of $280,000. And after subtracting selling and administrative expenses from gross margin, we see that net operating income is $120,000. So how about a little foreshadowing before we get to variable costing? In this example, fixed manufacturing overhead of $30,000 is deferred in inventory as a result of 5,000 unsold units at $6 of fixed manufacturing overhead per unit. It is not until sometime in the future, when the 5,000 units in ending inventory are finally sold, that $30,000 will be reflected in cost of sales and reduced net income. You might be wondering, why is this important? As mentioned previously, it is this characteristic that creates issues when it comes to pricing products and evaluating performance. Variable costing, on the other hand, eliminates these issues. It treats fixed manufacturing overhead as an expense in the period of production and does not attempt to match it with sales. Well, that's it for the moment. In the next video, we'll look at variable costing in more detail and contrast it with absorption costing. See you soon.